Good evening, everyone. Thank you all for joining us. While we wait for the rest of the participants to join, let's take a quick moment to explore 360 TF Verify, our new AI-powered solution that simplifies and digitizes the entire LC and supporting document checking process. Good evening, ladies and gentlemen. I'm Akshata Purohit, and we're delighted to welcome you all to today's Business Unplugged session, a platform where thought leaders from across the globe come together to share insights and spark conversations that matter. Thank you for joining us today for what promises to be an insightful discussion on managing treasury and trade finance in a multi geography world, from Africa to Asia to the Middle East. A topic that fascinates many but is discussed with such interest only by 360 TA. We are proud to host two distinguished experts, Jatin Brahmecha, Global CFO at Himalaya Herbal Healthcare, in conversation with Manasi Tiwari. I'm delighted to introduce Mansi as the SCF specialist managing global corporates at 360 TA. She has excelled in FI risk, open account solutions, and led the supply chain finance program from concept to implementation. Recognized with awards like Team Player of the Year and Best Deal of the Year 2023, she has also represented 360 TF at international forums while driving fintech-led trade finance innovation and global partnerships. Now, let's introduce our guest of the evening, Mr. Jatin Brahmecha. It is my privilege to introduce Mr. Jatin, the Global CFO of Himalaya Herbal Healthcare based in Dubai. With over 2 decades of leadership across international markets, he has played a key role in driving growth, strengthening systems, and successfully integrating large-scale businesses. Before joining Himalaya, he held senior leadership positions at Godrej Consumer Products, where he oversaw operations in Africa, Middle East, North America, and served as finance director in Indonesia. His career also spanned roles at ISS Facility Services, Godrej Highcare, Femcare Pharma, and Mahindra and Mahindra. As a chartered accountant and cost accountant, he brings deep expertise and a proven track record of transformative impact. Before we begin the discussion, I would like to invite our co-founder and chairman, Sir Pankaj Mantra. He has been at the forefront of the trade finance world with over 2 decades of experience in this industry and has been leading 360 TF at various fronts like BAP, ITFA, and ICC committees. Over to you, Pankaj, to share a few words.
Happy evening, Akshita and Jatin bhai. Once again, welcome to this very relevant topic for all of us, where not only the head of treasury, but the world entrepreneurs, the businessmen, the movers from Mittals to or moving to UAE, for the very reason that from this part of the world they can manage their family wealth and their large corporate, and of course the treasury officers over here. So very excited to have you here today. Friends, this is of course the season 2 of Business Unplugged of 360 TF, and I'm glad my colleague Mansi is, going to moderate this today. I know we all here, and if you see in UAE, whether it's me, Jatin bhai, and all other, fellow colleagues who are there in the call today, I probably see one of the key reason why we here is not only that we are running businesses in UAE or managing treasury in UAE, but UAE being the strategic location, mainly because of the time zone advantage, and of course the various other benefits infrastructure where we could and all of us could manage these treasuries of large offices while sitting in UAE. I feel very excited that as a 360 TF, we are also playing important role in supporting the global head of treasuries in their mission and vision to support, their, operations and bringing the cost down for their treasuries. In that sense, recently, of course, we secured our license in Gift City. And if you see between ADGM, DIFC, GIFT City, where most of the banks are sitting. They also play a very important role and access to the group CFOs and CEOs who are sitting in this part of the world to access those financial institutions to optimize the cost and the turnaround time. I would just quickly want to talk about our recent mm, product which we are launching formally in this Navaratri and the auspicious time, 360 Ops Assist. What is Ops Assist is basically if you see part of the global trade finance, one is the liquidity and the second is the documentation. So today, when you're raising and deploying funds under letter of credit, there are a lot of operation hassles and a lot of time which goes into doc preparation and document negotiation, which I feel is not where the treasury heads should be spending their time. So to assist treasury heads to delegate and outsource that operation work, we have created ops assist where they can outsource that work to 360 TF team with the purpose of reducing overall the treasury team costs to our expertise of CDCS qualified professional sitting in UAE in India. So that's our contribution to global treasuries by launching Opposite. But for of course managing the global treasuries and the cost and the efficiency, we look forward to listen to Jatin Bhai. So once again, Jatin Bhai, welcome and looking forward to hear from you. Thank you all.
Thank you, Pankaj. Thank you, everyone.
Thank you, Pankaj. I'm sure everyone is eager to hear their thoughts and insights. With that, I now hand it over to the panel to take the discussion forward.
Thanks, Akshata. In today's world, trade has evolved from being a purely transactional activity into a complex web of flows of goods, capital, data, and above all, trust. Africa, Asia, and Middle East stand at the crossroads of this transformation. Together, these regions account for over 60% of world's population and contribute nearly two-thirds of the global GDP growth, making them not only growth engines but also laboratories for innovation in treasury and trade finance. Yet, the paradox is striking. While global trade volumes reached nearly $33 trillion in 2024, corporates across these markets continue to face pressing challenges. Fragmented regulatory frameworks, currency volatility, liquidity mismatches, and widening trade finance gap, which is estimated around $2.5 trillion according to Asian Development Bank in 2024, while SMEs in Africa and South Asia bearing the brunt. At the same time, multinational corporates are being pushed to rethink treasury, not just as a control function, but as a strategic driver of resilience and growth. With this backdrop, I would like to begin. Jatinji, from your perspective, what is the current state of treasury and trade finance across Africa, Asia, and the Middle East? What broad trends are shaping the decision making in today's world?
Thanks everyone for joining the session, and thanks Mansi. Great question to start the session, right? See, while overall global trade has crossed 32, 33 trillion, as Mansi mentioned, the corporates are still struggling, right? They are battling with the liquidity constraints. They are battling with regulatory fragmentation, geopolitical risks. The logistical shocks and disruptions like container shortages we saw, Red Sea, the route disruptions we saw, right? And to me, I think these are becoming the new baselines. So we all have to kind of gear up and assume that something of the other of this sort will keep coming in our way, and we will have to be ready to tackle these things. Now, if I have to answer this question in terms of in Africa, in Asia, in Middle East, see, Africa is a very, very unique landscape. Okay, FX volatility and dollar scarcity dominates. Okay, when you go to Africa, if you have learned to source dollar, I think largely you have learned to even manage businesses. That can be the equation at times. Okay, it might not be 100% literal truth, but basically, I'm trying to tell you that managing FX is the most critical element. And if you're handling Africa as a region and you're handling treasury in that region, you are probably one of the most important and the key talent. Okay? See, Nigeria's unique setup where there is a proper central bank, proper banking rates are there, but there is a parallel banking economy. Okay, you always have two different rates thriving in the same market. Bank will have its official rate X, while parallel market might be 2X. Okay, and hence understanding how dollars gets allocated, the USD allocation mechanism, and how do you bid well is it really plays a very important and critical role. So one might think these are very set systems, but every day there are few new ways of handling same problem. And hence your banking network, your connections with the banks, has to be extremely strong. Some of you who are dealing with Africa, you would know even a lot of correspondent banks are de-risking themselves. So the access to global banks, the network for international payments is also going thin. So this is also causing good amount of pressure within Africa. Okay. But see, when there is this uncertainty, this kind of volatility, this kind of a risk, it brings in a lot of opportunity. Okay. If you have learned the trick well to manage your FX in Africa well, I think you are probably running ahead of your competition. And probably Treasury would be actually biggest contributor to the bottom line. Okay. So one example I would share is like even an equity infusion can be a great tool in Africa, especially in country like Nigeria. Like when I started handling Africa, even I wasn't aware, and many of my ex-treasury guys were not aware that there is some kind of a protection to your equity is provided through a particular process and a certificate in Nigeria. And we could even cover and hedge our some of the equity infusions done in prior 2 3 years. That itself created probably much more than next 2 3 years profits for the business in Africa. Okay, and hence extremely tricky, critical, and African treasury guy has to be alert 24/7 because there are windows of opportunities and you have to pick them right then and there. So having said about Africa, and again I touch base Nigeria because the largest market, most volatile market, very unique market. Accordingly, in various different markets, different scenarios are there. If you happen to be in Kenya, Kenya was operating with a very managed currency scenario, things were very different. But so having said that, let's move to Asia. Today, Asia is actually the most vibrant and probably leading. The story is growth, rapid digitalization, though regulations are diverse, right? So if you go to India, UPI in India is like probably many of the countries don't even handle that level of volume of transactions which UPI is handling today. It is supporting your vendor payments, it is supporting your payroll payments with real-time reconciliations and whatnot. If you go to Singapore, highly regulated, very structured, very advanced market, right? And in Singapore, you have platforms like Fast, where fast and secure transfers are allowing you to, straight through payments to your suppliers. So leading Asian banks also now provide API-driven banking integration. This has made a lot of your system and your external platforms talking to each other, and hence a seamless visibility to the cash, seamless reconciliations, and all of that has really gone to the next level. So net, I would say Asia is actually leading. When it comes to Middle East, relatively smaller market, but Treasury is again maturing very fast in this market. Hubs like Dubai and Riyadh are coming up and growing. The whole world is eyeing at Middle East. Most millionaires and billionaires and everyone is looking to resettle, set up their offices and move their families. And you would see it is buzzing right now. Okay. Now, obviously, these hubs are helped by AML, CFT upgrades. So AML has gone to next level. In last 7 8 years itself, I have seen these regulations are really they mean those regulations, and it is getting tightened. Okay, even instant payment platforms like Ani and many more have got introduced. However, having said all of this, one thing all of you should keep in mind: this is still influenced by oil cycles, and it has a USD peg. So as a treasury guy within Middle East, there is very, very predictable and stable market because you have pegged yourself to dollar. But fortunately, the entire Middle East actually thrives on trade with the world. And that is where the treasury plays the key role, right? When you deal with Africa, there are a lot of opportunities to actually structure the deals, a lot of opportunities to kind of fund your on-ground transactions and stuff. So Treasury has really shifted from control to strategy is what I would say over the years. And I have seen this function in last, I'm in industry for now almost 25 years. I have even seen the physical LCs, I have operated telex, I have sent LCs by fax, and I have seen all the chaos. So we are talking about now almost a lot of it being automated and probably the final legs which are still manual. I'm sure with 360 TF kind of players coming in and others coming in, I think we will actually go to everything fully automated, right? So Treasury has shifted from largely control to strategy, as I said, owning resilience while enabling growth through supply chain financing, receivable financing, and data-driven cash visibility. I think that would be the name of the game. Thanks, Mansi.
Very well said, sir. And I love how you say Treasury is now not no more a control function, but a strategic driver to businesses. Um, Looking from your experience and having worked in all these three geographies, what contrasts stand out most in financial infrastructure, currency regimes, and regulatory frameworks specifically? And how are corporates adapting to these differences in daily treasury operations?
Sure. See, on financial infrastructure, I would say Asia runs on dense banking networks, right? You will see a lot of banks come full of solid networks, real-time payment platforms, and bank APIs. This is all Asia. When you look at Middle East, it is modernizing fast via regional platforms and instant payments. And across most of Africa, payments run on world-class mobile economy, and these are all local payments platforms. But cross-border flows rely on very thin correspondent bank networks and uneven regional links. And that is where for Africa, you will find all FX transactions, whether dollar or euro or any other currency, these kind of transfers can be at times slower, at times costlier, at times less predictable. Okay. So that is how I would say, the financial infrastructure. When we come to currency regime, Asia is a blend of kind of free flow, or you can say a float and managed regimes. You have countries like China where currency is fully managed, country decides when to depreciate, how much to depreciate, while there are countries like Indonesia, India, and all these are almost very less intervention, less managed, and kind of semi-free flowing float currencies. Middle East skews to USD pegs, anchoring rates, but it largely imports all the Fed's moves. The moment Fed moves, say rates by 25 bips, you will very soon find same day or next day UAE also moving rates. Likewise, most economies here would actually move their rates. So for the sake of calling out, we have different rates, but largely we follow and mirror with the dollar pace, right? Then several African markets face FX scarcity, and as I said, multiple windows of FX allocations, and all these are the names of the game, and they are creating the pricing and repatriation friction. So in Africa, doing business, sending equity is very easy. Taking out money, there are very few ways, and hence that is where a role of an expert treasury function comes in. How do you even revisit your legal structure, organization structure? So generally, in any other part of the world, treasury guy doesn't really get into all of these. But the moment you are exposed to Africa, treasury guys are actually getting involved even in the legal structure of the organization, because he has to see it is not only money to be sent. At the end of the day, once the businessman is putting any money and making profits, the objective is also to repatriate them. And hence, before you enter, be clear on your route to exit. Okay? So that becomes very, very important. Then regulatory frameworks, I think Asia is very, very sophisticated. Obviously, country by country, there are variations. Middle East has tightened AML, CFT, and is pushing data-rich payments. So those who are sitting on call and are in Middle East, you would know, like, even an individual making payments, I have to actually declare so many things, the purpose, and they have already kind of created a template. You're sending the money for buying goods, you're sending the money for buying the services, you're sending the money for your home or your support to family and whatnot. So it is becoming, in a way, a very data rich payment system of Middle East. And Africa has seen uneven KYC standards, occasional correspondent bank de-risking, and almost a lot of uncertainties, and it is improving day by day. But these uncertainties, as I said, is the opportunity, and that's where the smart treasurers, smart businessmen are actually looking at Africa as the biggest opportunity and making their fortune out of it. Effect on working capital, I think longer and less predictable shipment settlement cycles in African corridor and steadier but USD sensitive funding cost in the GCC and faster collections or reconciliations is the digital heavy Asian market. So that is how I would say across markets how things are actually panning out today. So overall, risk and banking access, I would say Asia is very broad-based bank competition. And whenever there is a competition, obviously, as a customer, you become the beneficiary. Middle East is deepening its regional options, and Africa fewer routes in hard currencies, so higher fees or limits. Okay. You also had, I think, the next leg of your question was how do corporates adapt? Yeah, so I would say please use more than one bank and route. Don't depend on single bank, don't depend on the single route of payment. Okay, that would be the first advice. Whether payment platform or corridor or passing on or a banking partner or whatever, have multiple options on hand always. If feasible and beneficial, pricing your terms into local currency. Okay. I'll give an example. We have been pricing in our purchases in INR now for almost more than a decade. Okay, when we import from India, we actually sign in INR pricing. Very off late, government has now started, popularizing that you should do INR transaction and INR basically using for trade or trade terms. But we have been using INR for very strategically. Sorry, confirm your speaking language. Okay, I don't know. Some pop-up came in, so I'll just ignore that. Sorry. Yeah. So I don't know, Mansi, there is some pop-up on my screen. Confirm your speaking language, but I'll just ignore that for time being and continue. Okay. You're able to hear me, right?
Yes.
This is not disturbed. Yeah. Okay. Fine. So pricing in your purchase orders into local currency at times really will help. See, we all know INR, even though we are discussing INR on a reverse cycle for now consecutive 3-4 years, and in spite of all that, we have seen year over year there has been a depreciation, right? And structurally, if it helps for you to protect your rest of the world outside India business, then it is good that all of those companies, those businesses buy from your India subsidiary or India parent in INR. You're addressing two things. One, in India, you're not creating any exposure because they are INR currency books and they are exporting into INR. So zero exposure there. Now coming to the rest of the world who is buying into INR. Most currencies would actually be appreciating versus INR depending on where you are. So we currently export to US, Europe, Dubai, and rest of GCC markets. So we, in a way, kind of gain from INR depreciation into the P&Ls which are outside India, right? This also helps you from tax perspective. In India, all your profits are taxed. Outside India, your profits in many places are not taxed, or if business is in loss, obviously you're not paying any taxes. UAE now will pay taxes, but that also would be only 9%. Versus India will pay much higher taxes depending on again your entity structure. We pay 35%. Otherwise, most companies pay 25%. Right? Then I would say, how do you adapt to? You should stagger your FX cover. Okay. So buy foreign currency in small steps over time instead of one big bet. Okay. Again, here I would say, as a smart treasurer, if there is a knee-jerk effect and you are liquid enough, then take a big bet. Okay. And we did a big bet just, I think, couple of months ago when we saw INR to USD actually was at 85 and a half or some rate, and we had good liquidity. We in fact did one bullet payment from India. I have even gone ahead and done some advance payments for some of the buying, to suppliers or even dividend upstreamings, and that really helped. Today's rate is around 88 and a half, right? So, but as a discipline, as a rule, always stagger. But knee-jerk effect of good margin, as a treasurer, you have to take those calls and take some of the big bets. Never exhaust complete liquidity. That always you have to ensure. Match your financing to the reality. See, during all these shipping disruptions and stuff, we realized some trades, some people were actually doing hard-coded number of days, LC, hard-coded number of days, supply chain financing arrangements, and the shipping delays were actually much longer than your instrument validity itself. Okay, so change the terms in such a way that you are either you have a longer tenor or your tenor starts from when goods actually reach the destination, when you actually receive the goods and stuff. Okay, see what happens over a period when you don't, things are running smooth, this goes unnoticed, and suddenly when you have some events like this, you realize something gets stuck and you're in dilemma. Focus on automation, automate your systems with banking platforms. I think huge number of transactions take place on a daily basis. You need to have your reconciliations online, your invoice and payments matching automatically has to be there. So just focus on automation. Again, KYC requirements, I would say, are ramping up all across the world. So as a treasurer, you should keep your KYC file almost ready all 365 days. Okay. Keep the updated file always ready so that there are no delays at your end. And at the end, pull your cash and always have plan B, because plan A may or may not work. When you next morning get up, you see some different news on desk and your plan A is actually under big question mark. So how do you have a plan B? So centralize your liquidity, keep backup of the banks or routes in case the one kind of breaks. Yeah. So I would say.
Very well, sir. Talking about disruptions, we've seen many in last few years. We can talk about the COVID-19, the geopolitical wars, the Russia-Ukraine war, the Israel-Gaza war, and then these recent shifting trade policies, which has reshaped cash flows and supply chains in many folds. According to you, which disruption forced you to rethink treasury strategy the most, and what lessons helped you build resilience and come out of it?
I'll tell you almost every disruption, but I will pick up two. So, hands down, number one would be COVID-19, right? I think none of us, none of our parents, none of our grandparents, no one has seen an event like COVID-19, right? I think all of us were caught by surprise. all of us have probably gone through a thought whether I will be there next morning, next month, next year, whether my loved ones will be there or not there, right? Very, very scary times for the entire world. So it created an instant liquidity squeeze. Banks started reducing your overall limits. I remember we had so many limits with so many banks and we were never using it, right? First time in the history, banks actually approached saying, will you be okay if we reduce your limits? Because the whole world was in need of banking limits, right? And we happily actually reduced our limits. I can tell you in this forum, we reduce our limits by almost half so that someone else can get the benefit. Okay, because we as a group were never needed to have too much of borrowing, but we always had a lot of limits with the banks, right? And they were all unutilized. And that is where, the cash got tight overnight. Everyone started to feel the scarcity of cash. Again, we happened to be in the right business where actually our business was actually booming during COVID. See, pharma and probably hygiene industry actually saw a boom. So we helped kind of customers to kind of get some of the limits. But banks also started pulling back because when they saw businesses can struggle, they also don't want to kind of put their money at stake. So banks were pulling back your limits. Customer paid slower because they started to kind of conserve their cash because they don't know how long this event is going to continue. So it was probably the most challenging time I have seen. You have a cash, but you don't want to repay loan and reduce the cost of interest. Banks have a lot of money. They don't want to lend money because they don't know what state the businesses would be in, right? So a lot of these issues were actually we all faced, and cash actually became the king. In treasury, we always have heard cash is king. Every treasurer always say cash is king, but I think we understood that best during COVID-19, right? So daily cash check-ins, I don't think any treasury guy was like now or even pre-COVID was looking at so rigorously the cash balances daily. But during COVID, I think no treasurer would go to bed unless he had checked the cash balances. So very simple rule that time was protect cash first, everything else after that. Number two, I would say Russia-Ukraine war. Raw materials cost jumped. Some of the trade routes and partners became off limits. The currencies swung wildly, right? So what we did, we spread our hedges over time, not one big bet, because every day something was happening and every day situation was unpredictable, right? So added contract terms to adjust prices when FX moves. See, many times you hard code your currency and you don't keep it actually flexible to the FX moves. So even introduce the pricing with FX moves, during this war period because currencies were behaving crazy and used more suppliers, more shipping routes. So you are not dependent on any single one. So I would say that is how we handled COVID, the way we reacted to these war scenarios. And tariffs and sanctions and Red Sea detours made shipments take longer and riskier. So what we did, we made our trade finance last longer. As I said, the LCs kind of we made it a little longer, supply chain financing that cover the full journey. Though we have used very less financing, but that was the advice to whichever entity was kind of using it and kept the backup banks and routes ready in case of any one path shuts and hold enough liquidity at the center so that if any market really faces too many issues, we should be able to kind of help them with the liquidity. The lesson from all this, I think disruptions are not outliers anymore. Okay. Because in the last few years, we have seen you just get out of your bed in the morning and you get a news and you don't know how to react. You have to actually immediately start planning for. So treasury resilience must be institutionalized in the organization through liquidity buffers, diversified funding sources, multi-bank partnerships, and agile forecasting, and above all, go digital. That is what I would advise.
Rightly said, sir. Moving forward, ADB estimated the global trade finance gap at $2.5 trillion, unfairly affecting SMEs, particularly in Africa and South Asia. From your perspective as a large corporate, how do you evaluate and mitigate these counterparty and credit risks in such markets?
See, even large corporates face these risks. Okay, so it's not that small ones face, just that your ability to manage risks. You know, so in all these frontier markets, even large corporates like whether Godrej, Himalaya, all of us face risk. How we mitigate? We mitigate through obviously structured trade insurance, then multi-bank syndication for diversification, rigorous counterparty credit assessments, supply chain finance programs to support SMEs, which reduces the systemic risk and strengthens the ecosystem, right? So it is not just about protecting ourselves, right? It is about making the whole ecosystem resilient. Whole ecosystem should get lubricated. So that is how I would look at this.
Um, we see the financial centers, the matured ones like Dubai and Singapore, and now the emerging ones like Gift City, who are positioning themselves as global treasury hubs. Can these become truly a preferred basis for multinational companies? And what factors will drive adoption more for these financial centers?
Answer is obviously yes. And we have seen today in DIFC, in spite of the expanding so much space, not a single office is available, right? So obviously people are moving. I hope Gift City also kind of sees something similar. Singapore has been an established market. So the answer is clearly big, bold caps, yes. Okay. That is how I would say. And adoption depends on three things: the regulatory clarity, the financial infrastructure and technology, and access to the deep capital markets. So Singapore has regulatory depth, and Singapore has gained that reputation over decades. Dubai offers global connectivity and tax efficiency. So that is how Dubai has gained its reputation for these. And Gift City is emerging with incentives, fintech push, and a lot of that. So I would say Gift City obviously would kind of take both best of DIFC, best of Singapore, and try to kind of get rid of negatives of DIFC, negatives of Singapore, and probably create its own unique position in this world so that, a lot of companies, a lot of Indian corporates who are going out in Singapore, setting up setup or global treasury in Singapore or global treasury in DIFC, probably would tomorrow be attracted to Gift City, right? So for corporates, the choice is about efficiency, visibility, and cost optimization. See, really speaking, location will not make much difference. From many parts of India going to Ahmedabad, and from many parts of the world coming to Dubai and going to Singapore, the time difference is not much. And hence, I think, as I mentioned, the above other factors would play a critical role versus its physical location.
With regulations tightening globally, how do you balance agility and speed of business where there's a very strict need of compliance across multiple regions and it is growing every day? Do you also see the role of digital platforms being coming more in these?
See, technology is obviously transforming treasury into real-time intelligence, right? And is a function basically which is driving. So APIs give you the instant cash visibility. Blockchain is reducing LC cycles from weeks to days. We are moving. AI forecasting will also strengthen your liquidity and planning. Big data analytics is also coming in, right? So I would say with all of this, tomorrow's treasury won't just manage money, but it will actually orchestrate the intelligence across borders.
Um, with these new technologies emerging every day, do you also see sustainability and ESG linked financing becoming a part of treasury priorities along with digitization?
See, ESG obviously is gaining a lot of importance across organizations, and it will become kind of an agenda for most treasury guys. But please remember, it will not be probably the topmost agenda, because in the end, you are managing the money, you're managing the cost, you're managing access to liquidity. I think those fundamental expectations of treasury would still remain on top. But with all of these, if you're able to also kind of address sustainability, you're able to address ESG goals, obviously, people would move towards that.
Perfect. Drawing from your global journey across, I'll say, Singapore to UAE to Africa, what is one lesson or a piece of advice you would share with young professionals present today on this session and otherwise who are aspiring to build impactful global careers in treasury and trade finance?
One lesson is very difficult, but if I have to say one lesson, I would say treasury is leadership under uncertainty. Okay. Otherwise, there is no fun in managing treasury, right? So obviously, and we have seen uncertainty and volatility will be the kind of life for every treasurer. You will rarely have perfect information. Okay. So the good treasurer should be able to take decisions with available information, because you will rarely have a perfect information. But you must build resilience, foster the trusted partnerships, and apply foresight. So you will have to keep visualizing tomorrow what next. If in 2020 it was COVID-19, in 2024 it was Red Sea difficulty, what more scenarios can come in and strike, and how will you react? I would say make your organization future ready. Keep your answer to calamities kind of visualized and ready. How do you react? And I think in last 2 3 years, or last 5 years, whatever we have seen, I think we have learned a lot, and we should not forget those lessons. So that is how I would say that would be one lesson, that expect the uncertainty or expect unexpected always. For young professionals, I would say stay curious, embrace digital tools, and always think global but act local. I have seen multi-local will be the mantra. MNCs many times struggle because everything they try to kind of centralize everything. It has its own advantages, but when you're managing business in the worlds of Asia and Africa, I think act local, remain agile locally, keep good amount of decision making local, only high level strategic activities you centralize. If you can think global and act local, I think that would be the mantra. Forget for treasury for many aspects of the business.
Thank you so much, sir. I have noted it down and will take, I'm sure a lot of us on the call will take it seriously. With that, I guess I'll leave the floor open for, we have a lot of questions in the Q&A section. So I'll give the mic to Akshata now. We can take the questions from the audience.
Yeah, thanks, Mansi. Thank you to our panel for sharing their expertise with us. Now let's dive into the questions submitted by our audience.
Sure.
So the first one is, in your view, how can fast-growing businesses balance the need for treasury expertise with limited resources?
See, in fact, I will tell you, my global office, I have only two people working with me. Okay. So I don't think you need two large teams. Today, the amount of automation, amount of digitization that is taking place, right? I think you can remain on top of things. You can set up the right kind of what do you say, the triggers, the messages, the systems themselves are able to kind of send you triggers, escalate things by itself. So focus on technology, and I think technology will actually help a lot of stuff. Again, AI, I think with AI, I see a lot of my team members are able to turn around things much faster than the way they were turning around, right? Today, almost any assignment you give to someone, 50%, 60%, 70% of it, AI actually gives you ready solutions. And then you refine and build on top of that. I would say digitization and technology intervention is the name of the game. In fact, if you have too many people involved, it can actually slow down the decision making and the processes. So spend a lot of time on fundamental rules, fundamental policies. I think that is where your focus should be so that you know what scenarios, how you react. Rest, a lot of things you can automate.
Thank you, sir. Thank you for answering the question. The next one is, which countries are accepting invoicing in INR at present? If you can name a few.
Which countries? Sorry, which countries or which parties? What was the question?
Yes, which countries are accepting invoicing
We do invoicing in INR.
which countries?
Yeah, we do invoicing in all the entire GCC. We do invoicing in Europe. We do invoicing in US. We do invoicing even in Africa. We do in INR invoicing almost entire world. Sorry, but if you are an India-based business and you're invoicing to a third party, it is in your interest to really do dollarized billing. But if you have your own entities across the world and you want to kind of pass on benefit to them, do INR billing, or when you strongly feel INR is now going to be on reverse cycle, then move to INR billing. So that would be an additional piece of advice I would give. But you can actually do invoicing in INR. See what happens finally on the day of payment. Anyway, you convert that INR into dollar and you kind of transfer the money. But in a way, you are protected to you actually, the external country gets the benefit of dollar INR depreciation.
Got it. Thank you. So one of our attendee named Ganesh is asking how the trade finance and treasury needs to be shaped, especially during the current scenario of uncertainty because of tariff pressure. Do any economy can devalue the currency to have a sufficient pool of effects to mitigate the tariff?
See, many countries don't even allow you to hold enough FX in your hand, and hence the role of places like Dubai, Singapore, and some of these countries would come into play, right? Also, depending on which markets you are dealing with. So I'll share few examples here, without naming the roles. See, I was in Indonesia and we were doing a lot of our imports from China, okay? And all of them were actually dollarized, okay? And as a CFO, that point of time, I felt the kind of pressure China was going through, that China might actually devalue their currency. Okay. And it would be good to actually move our buying into RMB. Okay. And it was a sizable imports we used to have. the entire payment terms we moved to renminbi, okay, RMB, and I still remember, and I was not a global CFO, I was regional CFO, and this created a huge amount of ruckus in our system, that we are now taking exposure to a new currency. Okay. Now, before even we could conclude on this debate, China actually devalued renminbi, and we were actually beneficiary of few $1 million just because of this one switch, right? Because we analyzed what we were importing, and they were all actually sourcing their things into local currency, okay? And our prices used to get locked for longer duration. So you will have to really understand how your business is, and that is how you will have to take a call. And cash pooling, if you have options like Dubai, Singapore, or any other location, then keep all your money in dollars. So pool cash as much as possible. If you can hold in dollar, please do so. Else, obviously you will have to find different solutions. If you are just local business and only imports, you might have different struggle. I'll share one more example because we have enough time. So this was pretty long ago, and I would not only address this dollar INR financing, but I will also address how Treasury actually can play a much bigger strategic role. The business which I was handling was a very well-known brand, and was having good EBITDA, but the cost of borrowing was roughly 18% back in those years. Okay. So after depreciation and interest, it used to report losses. Okay. And we actually restructured this entire financing. We reduced our debt. A lot of restructuring was done. But to put you in a very nutshell, we moved to a foreign currency denominated loan, though we were not a big exporter, but this kind of facility was available. And we put our cost overall from 18% to under 6%. This itself made the loss-making company brought into a profit-making company. Okay, so at times you can be actually the biggest lever and biggest kind of story writer for companies turnaround. So looking at your situation, circumstances, you will have to really take a call as to how you want to really pull the cash, how you want to structure your debts, how you want to negotiate your suppliers and the payment terms.
Thank you for answering the question. One of our attendees would like to know your point of view on the treasury landscape 5 years down the line with AML progressing.
See, as I said, obviously AML is progressing very, very heavily. And with the kind of digitization happening, I think businesses will have to really have their documentation very clean. They need to know their customers also extremely well, right? So to me, I think forget AML, the whole digitization itself will make life easier, and the whole access to every information and AI will also make your life complex. So you have to keep things very straightforward, very clean, updated, and go digital. That's how I would say. So future is much faster, much cleaner, because you can't really hide the information. Now everything is almost open to the world. Any one of us can seek any information of any company today, any individual today. Things are very, very transparent. Even a lot of private companies, a lot of information you are able to source today. So you think are really private are probably already public. So please keep that in mind and go digital, keep things clean and clear.
Thank you for answering that. Uh, Not last but not the least question of this session. With Africa offering good potential but challenges like FX risk, credit insurance, and lack of local presence, how should smaller businesses establish themselves in the region?
Very good question. And this question is coming from a businessman, not a treasurer. Right. So, see, most people who have grown in Africa big. See how you start Africa, a lot of people start from Dubai. There is enough ready infrastructure available in Dubai which deals with Africa, and you kind of take exposure through them. They know how to manage local nuances and stuff. But this will not be a perpetual story if you want to say make 200, 300, 500, $700 million business in Africa, right? And now I would step out from this conversation of just treasury. I will wear the hat of businessman and the CEO. You will have to understand African consumer, African consumers' needs, and then offer the product to African consumer what he or she needs. I think that is where the success would lie. And the moment you get into that, you're exposing yourself to the whole Africa risk and you're taking the full blown exposure. That is where you need to deeply understand how that particular market works. If you are getting into Nigeria, then you should understand how Nigeria works. And Nigeria, obviously, Treasury, as I beginning also said, Treasury will play a critical role. If you are getting into Kenya, you should know how Kenya works, and you will have to customize your solutions to each market and then take the growth path. So start with probably distributors locally or start with exporting through Dubai. There are enough traders in Dubai who do exports to Africa. But if it is your dream of creating a few $100 million business in Africa, you will have to go locally into Africa.
Thank you, sir. Thank you for answering all the questions. We extend our heartfelt thanks to all esteemed panel for sharing their invaluable insights and expertise during the webinar. Thank you to all our attendees for your participation. We hope the session provided valuable takeaways and inspired new perspectives in the world of trade finance. Have a great weekend ahead and stay tuned as we come with our next episode of Business Unplugged. Thank you, everyone. Thank you for joining us.